In the hot, hazy summer of 1971, a currency crisis was brewing on a scale the world had never seen. In a remote, secured vault deep within the U.S. Federal Reserve, something terrifying was happening. The nation's gold was bleeding out. Every day, foreign governments, France, Switzerland, Germany, were arriving with sacks full of U.S. dollars, demanding the one thing the dollar promised to deliver: physical gold. They were essentially calling America's bluff. This was not a story of war, nor of empire collapse, but the quiet, agonizing death of a financial contract that had underpinned global stability for 3 decades. And the man who would pull the plug, President Richard Nixon, knew that in doing so, he was making a gamble that would reshape the global economy. What he and the world did not realize was that this single decisive action, taken on a quiet Sunday evening, would become one of the greatest economic policy shifts in modern history, a $750 billion mistake that would eventually transfer vast wealth from workers to the financial elite, fueling the rise of modern inequality. To understand the enormity of that Sunday, we must first go back to the ashes of World War II. In 1944, delegates from 44 Allied nations met at a grand hotel in Bretton Woods, New Hampshire. The economic memory of the Great Depression and the interwar period, characterized by competitive currency devaluations, protectionism, and financial anarchy, was fresh and horrifying. The primary goal was to impose order and predictability on global finance. The plan, heavily influenced by the U.S. Treasury and its dominant economic power, was the Bretton Woods system. This created what was known as the gold exchange standard, resting on a core, simple, elegant promise. The U.S. dollar was designated the world's primary reserve currency. The dollar, in turn, would be directly and reliably convertible into physical gold at a fixed price of $35 per ounce. A promise the U.S. made only to foreign central banks, not to its own citizens. All other major currencies, the pound, franc, mark, yen, pegged their value to the U.S. dollar within a narrow, managed band. This was the golden security blanket for the world. For the first time, the entire global trade system was built upon a structure where every paper note ultimately led back to a physical asset in a U.S. vault. The U.S. was the new banker of the world, and this gold standard was the bedrock of what would become the longest and most stable economic boom in history. For 25 years, it worked. Global trade flourished, inflation was low, and productivity skyrocketed. The American middle class rose to a level of prosperity never before imagined. It was the golden age of capitalism, all built on the promise of that $35 gold price. But the seeds of its destruction were sown in the very design of the system, what Yale economist Robert Triffin identified as the Triffin dilemma in the early 1960s. The U.S. was required to maintain 2 contradictory goals. The first, the banker's constraint, required the U.S. to maintain discipline over its currency, guaranteeing its value by maintaining massive gold reserves and treating the $35 per ounce promise as sacrosanct, a mandate for fiscal prudence. The second, the world's reserve requirement, stipulated that for the dollar to function as the world's reserve currency, the U.S. had to supply the world with a vast and increasing amount of dollars to facilitate global trade, investment, and growth. The dilemma was fatal. Fulfilling the requirement of supplying global liquidity inevitably undermined the constraint of maintaining gold convertibility. The more dollars the U.S. printed and exported through trade deficits, the more those dollars accumulated in foreign treasuries. Eventually, foreign nations would look at their mountains of paper dollars and the stagnant pile of gold in Fort Knox and correctly conclude that the U.S. did not have enough gold to back its promises. The system was designed to self-destruct once the world grew large enough to call America's bluff. And the U.S., having transitioned from the world's banker to the world's policeman, began to spend money on an unprecedented scale, aggressively fueling the dilemma. 2 monumental costs began to put immense strain on the system's foundation, forcing the world to question the banker's constraint. First, the Vietnam War, a massive, open-ended commitment costing billions of dollars. Second, President Lyndon B. Johnson's Great Society programs, huge domestic spending commitments for welfare and infrastructure. Both were funded not by raising taxes, an unpopular political move, but by simply printing dollars. The U.S. was essentially issuing debt faster than its gold reserves could possibly justify, running persistent balance of payments deficits. As these deficits mounted, foreign treasuries saw their dollar holdings swell while the U.S. gold stack remained fixed. The ratio of dollars held abroad to the gold reserves available for redemption was becoming dangerously unbalanced, a catastrophic misalignment of promise and reality. The foreign nations were not stupid. They began to realize they were holding an IOU for a bank running out of reserves. The man who truly sounded the alarm and turned the crisis from theoretical to acute was Charles de Gaulle, the fiercely nationalistic French president. De Gaulle saw the US dollar dominance not just as an economic convenience, but as an instrument of American geopolitical power, an exorbitant privilege. This privilege allowed the US to run perpetual deficits, fund costly wars like Vietnam, and pay for huge domestic programs, all using essentially free credit from the world. De Gaulle famously initiated a direct confrontational challenge to U.S. financial hegemony. In 1965, he announced that France would no longer hold U.S. dollars as reserves. He sent a French destroyer to New York, loaded with the accumulated U.S. dollars, demanding the promised gold. He continued to convert France's dollar holdings into gold, publicly challenging the U.S. Other major countries, including West Germany, quietly followed suit, converting their dollar holdings into gold, accelerating the gold drain. The U.S. became desperate. Every action the U.S. took to stop it, like threatening to withdraw troops from NATO or pressuring allies, only fueled the fire, proving that the U.S. was willing to play geopolitical hardball to avoid fulfilling its financial promise. The political bullying only confirmed the French president's suspicions. The figures became terrifyingly clear. Gold reserves had dropped from $20 billion in 1958 to under $10 billion by 1971. Meanwhile, the amount of dollars held abroad was 3 times that remaining reserve. The U.S. had less than 25% of the gold required to honor its global obligations. The collapse was no longer imminent. It was measurable and unavoidable. It all came to a head in the second week of August 1971. Britain, one of America's closest allies and a key pillar of the post-war order, sent a formal, urgent request asking to exchange $3 billion for gold. This was the final devastating blow. Nixon knew the U.S. could not possibly honor the request without wiping out its remaining reserves. The next country in line would finish the job, triggering a global financial meltdown and panic. On Friday, August 13th, Nixon called an emergency meeting at the presidential retreat Camp David with his top economic advisors. Present were Treasury Secretary John Connally, Federal Reserve Chair Arthur Burns, and a handful of others. The mood was panic. They were faced with 2 choices: the responsible choice, an unpalatable, severe contraction of U.S. domestic spending, cutting the Great Society, ending the Vietnam War, to restore faith in the dollar, which would cause a severe recession and almost certainly cost Nixon the upcoming election, or the radical choice, a unilateral, decisive move to sever the dollar's link to gold entirely, sacrificing global financial stability for U.S. political expediency and economic sovereignty. Connally, a blunt Texan, famously advised, "The dollar is our currency, but it's your problem." He meant the dollar's fate was now dependent on foreign central banks, and it was time for the U.S. to reclaim its financial sovereignty and escape the golden handcuffs. For Nixon, the choice was clear. Politics and sovereignty won over global stability. That Sunday, August 15, 1971, in a televised address, Nixon delivered the shock. He announced 3 decisive economic measures: a 90-day wage and price freeze to combat domestic inflation, a 10% import surcharge to force allies to revalue their currencies, and crucially, he announced that the U.S. would immediately and temporarily suspend the convertibility of the dollar into gold. The temporarily was the diplomatic lie. The move was permanent. The Bretton Woods system was dead. This move, known as the Nixon shock, was greeted with relief in the U.S., where it was seen as fighting inflation, and utter panic abroad, where allies realized the U.S. had unilaterally dismantled the global financial order. The world had gone from a system backed by gold to a system backed by nothing but faith, or fiat. The dollar was now a piece of paper backed only by the public's confidence in the U.S. government and the economic might of the nation. The immediate global reaction was chaotic. Financial markets shuddered for a week. When they reopened, foreign currencies, now free from the dollar peg, surged against the dollar, and global trade was thrown into confusion. The most immediate domestic consequence was inflation. With the anchor of gold removed, central banks were free to print money to fund government spending without the fear of a gold drain. Inflation soared throughout the 1970s. The initial 90-day price freeze failed to contain the systemic forces unleashed by the new fiat system. In fact, by removing the only mechanism that forced fiscal and monetary restraint, the U.S. effectively signed a long-term contract for future inflation. But the deeper, more profound consequence was the effect on capital and labor. Under the gold standard, the supply of money was tethered, and capital creation was relatively constrained. Investors and bankers knew that excessive money printing would lead to a run on gold. forcing restraint. Once the gold anchor was cut, the constraint disappeared. The financial markets were unleashed. The cost of money, interest rates, could now be manipulated entirely by central bank policy, not by the market's demand for physical gold. This created an environment where debt could be issued on an unprecedented scale, and asset bubbles became not just possible, but profitable and necessary for growth. Money could flow freely and be printed freely, chasing assets like real estate, stocks, and bonds. This massively increased the wealth of those who already owned capital. For the working class, the story was the reverse. Before 1971, there was a close historical correlation between the productivity gains of American workers and their wages. As a worker produced more, their real wage increased proportionally. This was the core social contract of post-war capitalism. After 1971, this correlation vanished. Productivity continued to climb, but real wages stagnated. Workers were paid in a dollar that was constantly being devalued by inflation, while the capital owners saw their assets, stocks, bonds, and real estate, rise exponentially on the back of free-flowing fiat money. The mistake was not the temporary suspension, but the failure to ever rein in the system afterward. The Federal Reserve, now completely unshackled from physical constraint, became the ultimate arbiter of the economy, essentially choosing winners and losers through interest rate policy and quantitative easing. This fueled financialization, where the economy began to prioritize high-risk, high-return activities in the financial sector over stable, wage-paying production in the industrial sector. The U.S. had transitioned from an economy where wealth was generated by making things to an economy where wealth was generated by trading money and assets. The ultimate consequence of this shift is that the primary benefit of money creation is now captured by the financial elite. When the Fed pumps money into the system, that money enters the financial system first, inflating the prices of assets like stocks and bonds before it ever reaches the wages of the average worker. This mechanism acts as a constant, subtle, yet massive wealth transfer from the bottom and middle to the top. The financial class essentially receives the new money at its highest value, before inflation fully sets in, while workers receive their wages later after the purchasing power has already been diluted by rising asset costs. The final lasting legacy of the Nixon shock is the dramatic rise in inequality over the last 5 decades. By disconnecting money from a tangible, limited resource, the U.S. gave itself and the financial class a superpower, the ability to create unlimited liquidity. This liquidity disproportionately flows to the top of the economic pyramid, inflating asset prices and increasing the returns on capital far faster than the returns on labor. The result is the massive gulf we see today, a world where the top 1% owns a disproportionate share of global wealth, and where an average worker's wages have barely moved in 50 years, while the stock market has soared. What Nixon intended as a temporary fix to preserve U.S. financial solvency became the great enabler of financial engineering and a wealth transfer that continues to define our modern political and economic landscape. The decision to abandon the $35 gold promise was hailed as a stroke of genius at the time, but history will likely remember it as the moment the system traded stability and fairness for unlimited monetary power, leading to a $750 billion and counting bill that the working class is still paying. The Bretton Woods system was a set of golden handcuffs that constrained government spending and prioritized economic stability. When Nixon broke those cuffs, the government gained freedom, but the financial system lost its necessary restraint. The consequences echo in every political debate about income inequality, every housing bubble, and every surge in the stock market today. The history you learned in school told you about the political motivations of the Nixon shock, but the real story is written in the ledgers. The severance of the gold link created a monetary environment that structurally favors capital over labor. Thank you for watching. If this video showed you something they left out, subscribe to Monetary Vault. There is a lot more in the vault, and we will show you where to look.